Welcome to Kaplan Professional's Economic Update. I'm Dan Purves. With me today is Shane Oliver, Head of Investment Strategy and Economics and Chief Economist at AMP Capital. Today we will be discussing falling house prices, economic warning flags, and how the US and China are positioning themselves in the early days of a trade war. Shane, welcome.
My pleasure. Thanks for having me.
There's talk of warning flags in the economy, such as overvaluation in the stock market, and the flattening yield curve in the US is also a concern. But other economic indicators are going strong. Why the mixed signals?
Well, it's often the case that we do get mixed signals, and of course that we're now at a point where we've sort of moved well beyond the low point in the economic cycle, which, depending on how you look at it, was several years ago now. It was either in the last recession globally was back in 2009. Obviously, there were recessions in Europe around 2011-12, but we're a long way from that. And we're also a long way away from the last downturn, which was around 2015-16. So we've sort of moved up through the cycle. We've seen a pickup in inflation. We've seen the US central bank raising interest rates. So in that context, it's natural to see the yield curve flattening out, and some people regard that as a guide to what will happen next in terms of economic growth. Historically in the US, there's been a good leading relationship between the shape of the yield curve and whether America has a recession or not. So that flattening obviously has created some consternation, but there's other indicators which are nowhere near as negative as that. Firstly, it's worth pointing out the yield curve in the US is still positive, as it is in other countries. It hasn't gone negative, so we're not inverted just yet. Secondly, there's a debate about what the yield curve itself is telling us. Some people say, well, the longer term end is distorted. In fact, the US Federal Reserve would argue, well, maybe you've got to look at a shorter dated yield curve. So the gap between two-year bond yields and short-term interest rates, it's actually been rising. So it's giving a different message again, despite having given the same lead over recessions in the past as the longer dated yield curve. So point is here, don't get too hung up on yield curves. They can give different messages. Likewise, when you look at the US, and I'm focusing here on the US because it's further advanced through the cycle than, say, Australia or Europe or Japan. But likewise, when you look at the US, other indicators are a lot more benign. We're not seeing anywhere near the housing boom that we saw prior to the last downturn in the US. We're not seeing a business investment boom. It's picked up, but still pretty modest compared to what it was prior to the tech wreck in 2000. If you look at overall cyclical spending in the US economy, allowing for consumer discretionary spending, it's also at a relatively low share of GDP. So we're not seeing the sort of exuberance, excesses that you normally see prior to a recession. We're not seeing a breakout yet in inflation. Inflation pressures are rising. By the same token, they still got very low wages growth in the US. So a lot of the things you'd normally look for to see a recession just aren't there yet. Maybe we'll get there at some point down the track, maybe 2020, maybe 2021, I don't know precisely when, but the point is we're not there yet. And that tells me that the broad environment for growth assets, assuming we avoid a full-on trade war, is still a reasonably positive one.
As you previously stated, the issue of rising trade war has been done to death, but it won't go away. The Chinese appear to be targeting Trump by putting a tariff on soybeans, an important industry for his support base, and Trump has offered $12 billion in emergency aid to those affected. As forecasting how this will play out is inherently difficult, a more apt question is, how are the US and China positioning themselves, and what options are they giving themselves for their next moves?
I think what's happening at the moment is that they're digging themselves into a bit of a corner, and neither side wants to give in. If you think back a little bit, this trade debate, well, it actually started in the presidential election campaign of 2016. Last year, of course, President Trump focused on tax cuts and deregulating the US economy, which in hindsight looks like he was planning to shore the economy up for this potential trade war this year. So he's bolstered the US economy ahead of tougher policies that he thought he'd implement this year. And of course, he started early this year with solar panels and washing machines, not much impact there. Then it moved on to steel and aluminium. Again, this was seen on a global basis. And of course, more recently, since late March, has moved to focus solely on China, because that's where America's biggest trade deficit is with. And of course, also America has these gripes that the Chinese haven't been respecting US intellectual property appropriately. So a lot of the the debate, the dispute is with China. Initially, there was some progress. In May, we did see negotiations between the Chinese and the US in Washington. Looks like they'd come to a good deal. President Trump was tweeting about it positively for the next day or so. And then, of course, he got a bit of a backlash from some of his supporters, said he's not tough enough. And then within a week or so, he'd actually backtracked and that deal was out the window. I think what's happening now is that the American side is feeling somewhat emboldened. The US economy is strong. You've seen support for Donald Trump actually maintain its pre-trade war levels, or trade skirmish levels rather. And in fact, if anything, it's gone up a little bit. So he's thinking, well, I've got to keep going down this path. It might help me or my party get re-elected come the midterm elections in November this year. So he's sort of dug in on one side, and the Chinese are saying, well, we had a deal with you and then you kiboshed it, so we don't trust you anymore, and they're digging in on the other side. So I suspect this conflict with China could go on for a little bit longer, quite possibly into next year, and therefore we may see more of those threatened tariffs imposed on China. But it is just worth bearing in mind here that the amount of imports coming to the US at the moment that have been subject to these extra tariffs are around 3 or 4%, depending on how you measure it. So it's relatively small. This is not 1929, 1930, when Smoot-Hawley regulations or bill put a 20% tariff on all imports. So we're a long way from a global trade war at the moment, but obviously the risks are worth keeping an eye on.
Thanks for being with us today.
My pleasure. Thank you.